Hello, everybody. We got a lot to cover today, so let's get started. Lots of moves in the market, lots of stocks that are moving. I will finish with a discussion of what's going on with the BTC Treasury companies right now. They are selling off because of NAV compression, and I have a big take on this. But anyways, let's get started and talk about SoFi. So SoFi finally catches a break. I am so happy. It is hard to think, and of course I own SoFi because, that's what I do. I just hold for stocks for years, and I held for the entire value of despair. I remember back in the day, I thought SoFi was a good deal at like 15, so I can't remember. I got it between like 10 and 15 on SoFi. And then we had this value of despair. Many people sold at 8, many people sold at 7, whatever. But the stock is up. The stock is finally bouncing, even though it had behaved like a stable coin for years. And so patience is rewarded. And I cannot think of a stock whose shareholders are more, deserving of this bounce. This is a bounce that is well deserved. For SoFi, it's been in the making for years. Stocks, when they do well, the coiled spring eventually pops. You can't keep the pressure on the coiled spring. Eventually it pops, and that is what is happening to SoFi right now. Because you may remember for years the stock was doing not much, but when you looked under the hood, everything was great, everything was fine, growth was there, everything was there. Just the market was not receptive to it because stocks bad, because banks bad, because rates up, so banks bad, essentially. Well, SoFi has made a major business shift in that same period. In now that they have 44% of their entire revenue is actually fee-based, and that's growing faster. So they could have more than 50% of the revenue fee-based. I don't think that's going to be the case because I think, this has been a wrong thought for years, but I think rates are going to drop. I mean, they're at least going to drop in May 26. That's like, because in May 26, Powell gets replaced. And of course, when rates drop, we know that the demand for lending, the demand for loans is unlimited. And so if rates drop, then SoFi can drop the rates, and SoFi can capture a lot of business for credit again. But their shift to fee revenue was the right thing to do for this current environment, and they made a right choice because, frankly, the rates are staying much higher than many of us anticipated. Anyways, it's not just about the rates. The true one-stop shop for SoFi is coming back. They're bringing back crypto, and I was very sour when they forced me to sell Bitcoin, because in Texas, SoFi didn't have a partner to transfer, so I was forced to sell Bitcoin at the bottom. I was very sour about that. I think a lot of customers were very sour when they did this, when they exited in 2022. They decided to not go the lawsuit route. They decided to exit crypto. Now they're bringing it back with a new administration. I hope they do a big launch of this, and I hope a lot of people are going to be happy, because now the one-stop shop story of SoFi is complete. Because in my world, like from a qualitative standpoint, you could not be considered a one-stop shop if you didn't have crypto. Well, you have crypto, now you're a one-stop shop. Again, crypto is the favorite investment of Gen Z. Gen Z is more likely to own stocks, to own crypto, than they are to own stocks, and so you gotta have it. The revenue growth has been really good. In an interview, a recent interview on CNBC this morning, the CEO mentioned their growth rate is 44%. So if it was year-over-year growth rate, that means that even if it drops a little bit, it's probably a much higher growth rate than even I was thinking for the next 12 months. So I need to update my spreadsheet. But if I update my spreadsheet with a growth rate anywhere between like 35 and 40%, this stock is going to begin to look very cheap, even at $24. So anyways, I think this surge is very well deserved. I'm very happy to see that. Let's continue now and talk about United Health. So United Health is down on the day. Is it 5%, 4% on the day? Because I guess analysts, are not happy because they said earnings growth will return in 2026. So I guess you have to wait, 5 months, and that's not very Wall Street-like to want to wait 5 months. And so the stock is being punished because you don't have the earnings growth right now. And also their medical loss ratio moved something from like 85 to like I don't know, 89 or whatever. But in my view, that's temporary, and it's temporary anyways because they raise their rates as they go. Negotiations happen all the time every year. Your rates raise, so if they spend a little bit more on the medical expense ratio, well, guess what? Insurance premiums are going to be much more expensive next year, and they'll be sure to not spend this much. So to me, the way I'm playing United Health is I'm playing it the same way that I played Charles Schwab back in the day. Do you remember Charles Schwab when there were, in the Silicon Valley Bank era? Charles Schwab sold off unexpectedly, traded down to 48 or something like that in the mid 40s, for really no apparent reason. And back then I was like, okay, well, I really like it a lot. I really like Charles Schwab a lot because I think it's an overreaction. It's taking advantage of an overreaction. Of course, I would never invest in Charles Schwab at these levels, just like I would never invest in United Healthcare when it was trading at $600. But now United Healthcare is not trading at $600. It's trading at $266. So this is how I am playing this. And if you're on the Patreon, I've told you about this trade, but I'm going to share. I'm not doing this trade right now. I'm just sharing it as it looks right now. So current price is 267. Let's say you get out of the money leaps for December 2027. So think about that. That's not quite 3 years, but that's a long time from now. 460 call, and so each call is $1,900. So $1,900. Anyways, how much return can you get if the stock gets back to $600? This stock traded at 600 or like 599.6 or something like that. So what if it gets back to 600 and you own out of the money leaps like this one, for example, and let's say it does that in a matter of a year or year and a half, and of course the faster the better. So this is 780% return if it's $600, right? Let's assume, so let's go with 900%. Let's go May 27th, right? So not quite a year, in 10 months. What if in 10 months United Health is back at 600? Well, if you own the leaps, that's a 10x, 900%. You make a 900% return, i.e. a 10x, if it goes back to 600. Pretty much, if United Health goes back to $600 anytime within the next 2.5 years, you're looking at a 6x to a 10x return on leaps. And so that's why, for this type of stock, after a big market drawdown like this, I like leaps very, very, very much, and that's why it kind of makes it way on a growth channel. But I would never touch that. I would never touch that if I were to have to pay 600. The only bet you have to make in this type of setup is do you think the company is going to disappear? Do you Charles Schwab, UI UX is horrible. I don't like it at all. I had to use it recently with the treasury companies that they have. It hasn't been updated in forever. They didn't have good takes on crypto for a very long while. They brought back fees. Kind of when you're founded in the 20th century and rent seeking is part of your DNA, you're gonna bring back the fees, even though Robinhood is not. Robinhood is taking so much share. But was it gonna go back to more or less what it was? Yeah, sure. And even if it were to go back to 10% less than its former self, over a very, very long run, over, say, a year, 2 years, 3 years, stocks tend to revert back to the mean. And that's why, with options, it becomes interesting. I personally think United States is going to revert back to the means because their health plans are going to be profitable again because they're going to raise their prices and they're going to deny more. It's unfortunate, but it's how kind of this business works. I don't like the insurance business. I don't want to be in that business at all. It's a trade. This is a trade. I'm very clear about that. But they also have their Optum services. And this is where you have actual tangible value. They're the number one employer of doctors in America. Actually, United Health, 70,000 employed MDs. I happen to know one of them really well, and I can tell you, that it's a bloated, overly bureaucratic organization, but it's also you can't really disrupt the physical world like this. They own so many clinics, and so more than 2,000, right? They tell you right there. Some of them are giant, like for example. I'm just going to throw this out there. Like, say, go to the Houston area. If you're in Houston, have you seen Kelsey Siebold Clinic? It's absolutely huge, right? And they own like dozens of these facilities. Look up in your area what's like a main clinic, and the odds are it's going to be owned by United Health. They own a lot of these. You can't replace, and the type of care that they do. Unfortunately, it's a lot of 65 plus care. It's a lot of tougher care that cannot be disrupted just yet by technology, where HIMSS is not really helpful at this point, right? HIMSS is not going to disrupt cancer care, right? It's like so. Anyways, I don't think all of this to say that I don't think this company is going away, and if it's not going away, I think it's too cheap. So that's why this is my trade. This is how I like United Health, and I'm playing it. And frankly, the stock is holding up pretty well, -5%. It's holding up pretty well. All right, let's talk about something else. Talk about Novo. I continue to say no to Novo. And I know a lot of my viewers like Novo, and sometimes I would argue people like Novo, especially in the comment section, because it's easier to buy in Europe. You can put it in a tax advantage account. Maybe you have a little patriotism and you want to buy the European player. There's a reason. I think it's one of the key things. But again, like Kering was trending this morning. Like look at what happened with Kering and a lot of the luxury brands. It's, your location of the company should not be the prevailing factor. And if it were a factor, quite frankly, I would want to invest in a company in the United States. That's if it were a factor. It's not a factor for me. It's just that when I look at Novo, yeah, the stock is down 58%. Is it going to revert back to the mean? Maybe a little bit, but I'm not so sure, because there's more issues coming up. The issue is pharmaceutical tariffs, and of course right now we're finding out that they may be 15%, and people are getting very upset that the tariffs could be 15%. And you're going to tell me, well, tariffs don't impact Novo. They have a manufacturing facility in the USA, and they do. I think it's in South Carolina. Yes, they do. But two quick questions. Importantly, and these things, they're fungible. It's a little bit fungible. If you make Ozempic for the USA market, well, it probably costs you much more to make it than if you make it in another area, and you can't ship the cheaper products. So that's one aspect. There's fungibility to these drugs, i.e. each dose of Ozempic is the same regardless of provenance. And so the question is your Carolina facility big enough for you to supply the expected demand for GLP-1s in, say, 2030? Because the demand is expected to be much bigger than it already is. So that's point number one. But then point number two, and this is more importantly if you're looking at Novo as a trade, do you think the market will care about such a nuance that they own actually a manufacturing facility in the US? I don't think so. I think the market will be like, okay, this is a basket selling, European healthcare, European pharmaceuticals bad, and you'll have basket selling behavior whenever this news comes back up. So that's kind of my take on this. And of course, from a business standpoint, I also think that there is a credible threat to semaglutide, and that credible threat already exists in the form of tirzepatide, right? Tirzepatide is the better GLP-1. It has dual action mechanism. It acts on two receptors. Anyways, a lot of people prefer it. It can handle more extreme cases of overweightedness. But the bigger problem is that you might have retatrutide that is coming. And of course, retatrutide, a lot of people are already taking it, buying it on peptide websites. But retatrutide is in phase 3. And if and when, and it's more likely when retatrutide gets approved, not only will you have Lilly, who has tirzepatide, but they will also have retatrutide, which is going to be a triple action process. So fundamentally on these businesses, if I were to analyze these businesses from a fundamental standpoint, which I don't, because the only type of pharmaceutical company I love are kind of like deep tech pharmaceutical companies who have revolutionary drugs and high growth. These are way too mature for my style of investing. But if I were into that style of investing, I would pick Lilly any day. I really would, because they're gonna have rate of trade coming, and of course these companies make over drugs and over products, and this is also something that's anyways, the market, just like the market is judging HIMSS mostly based on GLP-1s, I bet you the market is judging Novo and Lilly mostly based on GLP-1s, even though these companies do more than GLP-1s. But anyways, so I still say no to Novo, but if you own it, I wish you good luck. And then the last point. So people are freaking out, because MicroStrategy's, not called strategy, strategy's price to NAV is a 1.56, and yesterday it was like a 1.59. So people are freaking out. And I don't know if this is a trend or a fad that was started by more traditional Wall Street analysts. I was listening to this latest CleanSpark interview, CleanSpark CEO interview yesterday, where they were talking about how it's pretty much the Wall Street analysts who forced them to sell Bitcoin. And my understanding of it is that it was much more accretive for them to sell shares to fund the electric bill, to pay for your electric bill, to pay your expansion. You sell shares. This is more this is accretive, right? This is accretive when you sell shares and you mine Bitcoin for like 45K and you sell shares to finance that electric bill. It's accretive, but they, because of Wall Street, they had to create a taxable event and sell the Bitcoin to fund the electric bill. It's a caricature, but that's essentially what we're seeing with this wave of FUD. And so that's why I say math beats Wall Street. Like, do the math. And my video here, didn't. I mean, I guess I'm happy. It got like 3,000 views, so I'm very happy. It got more than when I made it. But the point is walk through the math, input whatever NAV you want, and ask yourself, is it accretive or not? And the answer is yes, it is accretive. Yes, you're actually generating a return. These companies' chief product right now is their stock. The stock is the product. So Strategy stock is the product, Metaplanet stock is the product, Smarter Web stock is the product, and Mara is now trading at just under a 1 NAV, and this also confirms my thesis that it's very tough for these companies to trade below 1. But you get Mara, you get everything with it, right? You get the miners, you get the energy assets, you get the windmills, you get the land, you get everything for free. And you get like a 1% discount on the Bitcoin that they hold in the balance sheet. So for Mara, it doesn't work to do price to NAV accretion. It doesn't work for them to collect the premium because there is no premium to be collected on Mara. Mara is not trading at a premium, but Mara is doing it right because they did a convertible debt. And if you do a convertible debt and you have a conversion price that is higher in the future, you're just diluting in the future accretively for the money today. You're diluting accretively in the future for the money today. That's why they have these embedded options in the convertible debt that allow you to still do it efficiently. If your price to NAV is trading at a 1, you should probably do a convertible debt and capture that premium, kind of like if you were to write an option on your own stock. Well, convertible debt is kind of like the company writing an option on their own stock and collecting the premium for themselves. So that's the point here, and so this whole FUD of dilution bad, sell stock because dilution bad. I just realized making this video, this is something that I've always understood. Like, as you know, on this channel, I typically don't mind dilution. Like if you look at a stock like Amazon diluted itself all the way to the top. If you look at a founder of the business, a founder of any business, any billionaire out there probably became a billionaire because they diluted their way all the way to the top. Okay, so it's important to start thinking of the stock as one of the products that a company sells. A company sells goods and services via the revenue line, and it's not very attractive to sell goods and services via the revenue line because you get taxed like crazy. Okay, but when you start thinking of your stock as the product, and when you sell it via the balance sheet. You don't incur any tax. You're raising money. And I would be fascinated to do a study to see how much a founder of any company, how much wealth they've created by actually selling their idea, selling their business, versus buying back the business when the company is mature and finally buying back the business. And this is where Saylor is, I think, initiating a big shift in corporate finance, where actually stock buybacks are going to be seen as a bad thing. And, I've always hated dividends. I never really understood dividends. Dividends, to me, I've always been, death by 1,000 cuts. I've always hated dividends. But buybacks are kind of the same thing, especially now that we have a new 1% tax on buybacks. And when a tax is in place, typically it only goes up. What if the tax on buyback is 5% in the 2030s? So I think we're going to see a shift in corporate finance where people are going to start judging what kind of analysts preach as a bad thing. Because when Eddie Lampert bought $5 billion worth of Sears stock back in 2004, but sent away the intern who wanted to update the lights on the floor, that was a bad decision. That was a bad move for Sears to buy back $5 billion worth of stock in 2004. They should have taken that $4 billion and they should have put it into Bitcoin. And if the stock was hot, then what should they have done? They should have probably sold a little bit of that stock. Another intuition that I've always had, and this is why it's important to think for yourself, a lot of people hate dilution. Do you know why you hate dilution? Do you really know why you hate dilution? Dilution of a stock is not going to be as high as dilution of a money supply, right? The dollar is diluting at 15%. So if your stock is diluting at less than 15%, why do we even care? Your stock is diluting less than the dollar, but also dilution is very, very often accretive, in my view. In these Bitcoin treasury companies, it provides simple math to conclusively calculate that there is value created via dilution. But on this channel, I've said before, how do you want to pay your top talent? How do you want to pay your executives? It's from an anti-fragility standpoint, assuming you can quantify the benefits of being anti-fragile, it's so much better to pay your executive with stock. Because if you pay your executive with cold hard cash, well, your company becomes more fragile. You can't handle shocks in the marketplace. But if you pay your executives with stock-based comp, you're just selling your stock to pay your executives. So you're keeping the cash on the business. It's a war chest. It's there for you. If there's a crisis, you can handle the crisis. So I think a lot of the models that we have in corporate finance right now, they're due to people who got their MBAs back in 1965 or whatever, and they're still pushing these old ways of doing things, not even remembering that really in 1965, mental models on finance in 1965 and in 1970 were markedly different than they were in the 30s. And then in the 80s, you had things like EBITDA, etc. I love EBITDA. Some people still criticize EBITDA. Yes, depreciation is a phantom expense. It's a fake expense, right? Look at Mara. They depreciate the miners over 3 years, but they have miners who are still running and kicking and producing Bitcoin, and some miners are 7 years old. Go to any old factory, any old plant. You'll see people using machines sometimes that are more than 100 years old. The machine still works. They depreciated over, 10 years, 15 years. So yeah, EBITDA makes a lot of sense. But you still have people who say, oh no, I like GAAP, I like this, I like that. I want a committee to tell me how I should judge the thing. So this goes back to first principles thinking. And so to me, this is a Wall Street freakout, and nothing more than a Wall Street freakout. I argue that we're going to see a lot more companies starting thinking of their stock as something that they sell, just like they sell products that generate sales and revenue. You can sell different things as a company via different lines, and they are taxed differently. And this is Saylor who initiated this change. So kudos to Saylor. He might be remembered, of course, as a Bitcoin teacher, but also as a corporate finance teacher. And anyways, so long-winded description here, but hopefully you learned a thing or two. And as always, we can agree to disagree. This is not. This is my truth. This is not everyone's truth. And sure enough, many of you disagree with me on a lot of things. But anyways, this was not investment advice, not financial advice, not accounting advice. No advice ever here. This is only entertainment. I hope you're entertained. Please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.